Welcome to Stock Wars. This battle between dividend stock combatants will determine who seizes intergalactic supremacy and is the most attractive food manufacturer going forward. The first Stock Wars combatant is Kellogg's. Kellogg's Company, together with its subsidiaries, manufactures and markets ready-to-eat cereal and convenience foods. Kellogg Company was founded in 1906 and is headquartered in Battle Creek, Michigan. The company operates through 4 segments: North America, Europe, Latin America, and Asia, Middle East, Africa. Its principal products include crackers, crisps, savory snacks, toaster pastries, cereal bars and bites, granola bars and bites, ready-to-eat cereals, frozen waffles, veggie foods, and noodles. The company offers its products under the Kellogg's, Cheez-Its, Pringles, Kashi, Bear Naked, Eggo, Nutri-Grain, Special K, Pop-Tarts, Rice Krispies, and Garden Burger brand names. The second combatant is General Mills. General Mills manufactures and markets branded consumer foods worldwide. It operates 500 leased and 358 franchise-branded ice cream parlors. General Mills was founded in 1866 and is headquartered in Minneapolis, Minnesota. The company operates in 5 segments: North America retail, convenience stores and food service, Europe and Australia, Asia and Latin America, and pet. It offers ready-to-eat cereals, refrigerated yogurt, soup, meal kits, refrigerated and frozen dough products, dessert and baking mixes, frozen pizza and pizza snacks, snack bars, fruit snacks, nutrition bars, and savory snacks, as well as organic products, including refrigerated yogurt, frozen and shelf-stable vegetables, meal kits, salty snacks, ready-to-eat cereal, and grain snacks. The company offers its brands under the Betty Crocker, Bisquick, Blue Buffalo, Cheerios, Chex, Cinnamon Toast Crunch, Cocoa Puffs, Cookie Crisp, Fruit Roll-Ups, Go-Gurt, Lucky Charms, Progresso, and Yoplait trademarks. Let the battle begin! Kellogg's is currently trading at $62.42 and is down over 4% year-to-date. Over the last 5 years, Kellogg's is down over 18%. General Mills, our other manufacturing food giant, which is currently trading at $60.86, is up this year, seeing an increase of just over 1%. With that said, General Mills is down just under 1% during the last 5 years. Now let's take a look at which combatant may perform better going forward based on its current valuation. The first item to compare is market cap. Market capitalization, commonly called market cap, is the market value of a publicly traded company's outstanding shares. Market capitalization is equal to the share price multiplied by the number of shares outstanding. Market cap is probably the least important metric in Stock Wars, but it is an indicator of public opinion of a company's net worth and is a determining factor in some forms of stock valuation. From a market cap perspective, General Mills is the larger company with $37.2 billion compared to $21.4 billion for Kellogg's. Both are cereal manufacturing favorites, but General Mills takes this first metric comparison in this Stock Wars battle with $15 billion more in market cap. The second Stock Wars metric comparison is revenue. Revenue is the income generated from normal business operations. It is the top line or gross income figure from which costs are subtracted to determine net income. Who generates more revenue in this epic Stock Wars showdown? In 2020, Kellogg's had $13.7 billion in revenue, while General Mills came in at $17.6 billion in revenue. General Mills wins the second consecutive metric in this stock wars battle against Kellogg's. The third metrics comparison in stock wars is further down on the income statement. Net income or profit. Profit describes the financial benefit realized when revenue generated from a business activity exceeds the expenses, costs, and taxes involved in sustaining the activity in question. For the third metric in this stock wars battle, General Mills takes the win with $2.18 billion in profit, while Kellogg's came in at $1.25 billion. General Mills has now won the first three metrics in this epic stock wars battle. Knowing the profit for each combatant transitions into the next metric in this stock wars comparison. Profit margin. Profit margin is one of the commonly used profitability ratios to gauge the degree to which a company or business activity makes money. It represents what percentage of sales have turned into profits. Kellogg's comes in with a profit margin of 9.12%, while General Mills is at 12.38%. For the fourth metric in a row, General Mills wins. Both corporations have decent profit margins, which is surprising in the price-competitive food manufacturing sector. As the stock wars rage and General Mills maintains a 4-0 lead in this battle, the fifth metric is in sight. 3-year revenue growth. Revenue growth illustrates sales increases or decreases over time. It is used to measure how fast a company is expanding or contracting. Kellogg's comes in with a 3-year revenue growth of 2.8%, while General Mills wins a fifth metric in a row with a 3-year revenue increase of 3.2%. As the two cereal titans battle for dominance, PE ratio emerges as the sixth metric in stock wars. The price to earnings ratio is the ratio for valuing a company that measures its current share price relative to its per share earnings. The price to earnings ratio is also sometimes known as the price multiple or the earnings multiple. When examining the forward PE, Kellogg's comes in with a metric of 15.73. while General Mills boasts a forward PE at 16.49. Kellogg's comes out on top for the first time in this stock wars matchup. As the battle rages between these food manufacturing juggernauts, dividend yield is the next metric comparison in stock wars. The dividend yield, expressed as a percentage, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. Kellogg's comes in with a dividend yield of 3.73%. General Mills, on the other hand, is at a lower 3.35%. For the second time, Kellogg's wins a stock wars metric. Both yields are decent. Continuing on, the next metric is years of consecutive dividend increases. Companies with a track record of dividend increases tend to be more stable and motivated to maintain that track record. When analyzing the two combatants, Kellogg's boasts 16 years of dividend growth, while General Mills comes in at 0. In this metrics battle, Kellogg's comes out on top, now on a 5-year dividend growth, which is the next metric in this stock wars battle between these leaders of food manufacturing. The dividend growth rate is the annualized percentage rate of growth that a particular stock's dividend undergoes over a period of time. Many mature companies seek to increase the dividends paid to their investors on a regular basis. According to Fidelity, Kellogg's has a 5-year dividend growth rate of 2.66% compared to General Mills at 2.09%. Kellogg's claims the metric in this stock wars matchup. This begs the question for the next metric. How safe are the dividends? The Dividend Safety score system takes into account more than a dozen fundamental metrics that influence a company's ability to continue paying dividends. According to Simply Safe Dividends, Kellogg's has a score of 66, which is considered safe. On the other side of this matchup, General Mills has a score of 69, which is also considered safe. General Mills is the victor of this Stock Wars metric. The 11th metric in this Stock Wars contest also reflects on dividend safety, the payout ratio. The payout ratio is a financial metric showing the proportion of earnings a company pays shareholders in the form of dividends. This is expressed as a percentage of the company's total earnings. Currently, Kellogg's payout ratio is at 62.81%, while General Mills is at 49.51%. Both payout ratios are good, but General Mills is the winner of this Stock Wars metric. Moving on quickly to the 12th metric, the two food giants will compare current ratios. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. Kellogg's clocks in with a current ratio of 0.66. General Mills, on the other hand, sees a current ratio of 0.69. The higher the current ratio, the better. Therefore, General Mills takes this Stock Wars metric with a slightly higher current ratio. The last Stock Wars metric is debt-to-equity ratio. The debt-to-equity ratio is calculated by dividing a company's total liabilities by its shareholder equity. These numbers are available on the balance sheet of the company's financial statements. Kellogg sees a debt-to-equity ratio of 2.61, and General Mills comes in at 1.56. While both are well over 0.5, which means their assets are financed by debt, General Mills gets the better of this metric and wins another one. In this Stock Wars battle, General Mills won 9 metrics compared to Kellogg's, who won 4. General Mills is the winner of this epic Stock Wars battle of these food manufacturing favorites. General Mills wins the overall Stock Wars battle from a metric standpoint, but the battle was relatively close between these two popular food manufacturing titans. That being said, both companies seem fairly priced if you believe that their health and long-term prospects are solid. If you missed the first 8 episodes of Stock Wars matchups, please check them out and let me know what you think. I'll leave links in the description. Stay tuned for future Stock Wars episodes, and please like, subscribe, and turn on the bell notification so you don't miss any future episodes. Comment below if there's a particular battle you'd like to see. Until next time, remember, I am not a financial advisor. The opinions expressed in this video are solely for educational and entertainment purposes. Any stock purchases I show on video should not be considered an investment recommendation. Investing involves risk, and you should do your own research. For investment advice, please seek the counsel of a financial investment advisor.